Hyperliquid has been making waves lately, with some even calling it the on-chain Binance. Over the past year, this decentralized exchange has gone from being barely known to pulling in massive trading volumes. At the start of last year, Hyperliquid's all-time high 24-hour trading volume was around 1 billion. Now it's hit over 22 billion. Its user base also surged from 30,000 to over 400,000. So what's driving this rapid growth? Well, let's break it down. In case you're not caught up, Hyperliquid is a layer 1 blockchain powering its own flagship decentralized exchange. Unlike most DEXs, which operate on Ethereum or other general purpose blockchains, Hyperliquid runs its own chain, optimized for high performance trading. A major difference is how trading is facilitated. Most DEXs, like Uniswap, use automated market makers. Hyperliquid, however, uses an order book model similar to Binance or Coinbase, allowing traders to place more precise orders directly on-chain. Liquidity on Hyperliquid is supported by the Hyperliquidity Provider, or HLP Vault, where users deposit assets. These funds are used in automated market-making strategies, placing buy and sell orders like a professional market maker. The Vault's earnings or losses depend on how well these strategies perform, plus any trading fees directed back into the Vault. For example, the Vault places a buy order for Bitcoin at 50,000 and a sell order at $50,100. If both orders get filled, the Vault profits $100 per Bitcoin. Additionally, Hyperliquid has an on-chain liquidation system, meaning when traders who use leverage get liquidated, the Vault can buy liquidated assets at a discount and resell them for a potential profit. All of this runs directly on Hyperliquid's layer 1 blockchain, powered by HyperBFT, a custom-built consensus mechanism which prioritizes speed over decentralization, a trade-off that we'll touch on later. Transactions settle in under a second, and the network can handle up to 100,000 orders per second. Hyperliquid DEX leverages this technology to power its biggest product, perpetual futures trading. Traders can bet on price movements across over 170 trading pairs and use up to 50 times leverage, allowing them to open larger positions with less capital. For those who prefer regular buying and selling, Hyperliquid also offers spot trading for 80 coins at the time of shooting. Both perps and spot trading benefit from Hyperliquid's on-chain order book to give traders better price execution compared to AMM-based DEXs. So as you can already tell, Hyperliquid is trying to make the decentralized trading experience feel just as smooth as its centralized competition. This is a big part of why the project has gained so much popularity. Beyond fast execution speeds, thanks to HyperBFT, Hyperliquid also adopts a gas-free model. Users can place orders without worrying about gas fees, and they only pay trading fees when their orders are executed. Aside from the platform's features, there are other reasons why Hyperliquid has drawn so much attention, and to explain that, we need to take a look at its background. Hyperliquid was built by a team of experienced traders and engineers led by Jeff Yan and Illy Enzing, who met as classmates at Harvard. Their team also includes contributors from Caltech and MIT with backgrounds in high-frequency trading, blockchain engineering, and UX design. Some of them have previously worked at companies like Airtable, Citadel, Hudson River Trading, and Neuro. However, beyond Jeff Yan, there isn't much publicly available information about the other team members. That said, unlike most projects, Hyperliquid is entirely self-funded. The team claims this allows them to focus purely on product development with no VC influence or pressure from private investors. This community-first approach is also reflected in its tokenomics. Unlike many projects, there are no allocations for private investors, centralized exchanges, or market makers. Instead, over 70% of the supply goes directly to the community. 23% is allocated to current and future core contributors, and 6% is held in the Hyper Foundation budget. Because of this user-focused distribution, Hyperliquid was able to run one of the largest and most successful airdrop campaigns, which played a major role in its rise to popularity. The Genesis event in November last year distributed 310 million Hype tokens to eligible participants, and this amounted to, at the time, around 1.5 billion. Now, anticipated airdrops tend to boost activity on a platform, but usually activity drops sharply afterward, as organic engagement tends to be lower. However, Hyperliquid managed to sustain its user activity even after the airdrop. The project also gained a significant lead over other perpetual dexes like Jupiter and GMX in terms of trading volume. At the time of shooting this video, Hyperliquid accounts for over half of all perpetual dex daily trading volume, putting it well ahead of its competitors. So, good tokenomics, healthy organic network activity, and a sex-like experience in DeFi. On paper, Hyperliquid sounds like the perfect platform. But what's the catch? The biggest concern is decentralization, particularly when it comes to validators. Hyperliquid achieves its impressive network performance by making trade-offs in decentralization. Initially, Hyperliquid's network was secured by just 4 validators, all operated by the core team. Now, this naturally raised concerns about centralization and the risks that come with it. To address this, the team expanded the validator set to 60 nodes, but that didn't completely eliminate concerns. There was also criticism about how these validators were chosen, and the community demanded more transparency. The team responded and denied allegations that validator seats were being sold and stated that selections were merit-based. They also outlined plans to expand the validator set further as the network grows. However, the foundation nodes still control about 80% of staked Hype tokens, which adds another layer to the centralization debate. Beyond validator concerns, Hyperliquid also faced scrutiny over its closed source code and reliance on a single binary. This means all validators have to run the exact same software provided by the team, which reduces network diversity and could create a single point of failure. In response, Hyperliquid committed to open source the code once it reaches a stable state. They also defended their single binary design, pointing out that even mature networks like Solana rely on a single client, though Solana has seen improvement in recent years with new clients launching. Aside from centralization, there's also the issue of security and resilience. Because Hyperliquid is still a relatively new platform, it hasn't undergone the extensive battle testing that blockchains like Ethereum or Solana have gone through over the years. That said, it did suffer a security scare late last year. Security experts spotted suspicious trading activity linked to North Korean hackers, with reports suggesting that they were testing Hyperliquid security. These hackers were responsible for some of the largest crypto exploits, including the 600 million hack of the Ronin Ethereum sidechain in 2022. The incident sparked major concerns, leading to over 250 million in withdrawals from the platform. In response, Hyperliquid reassured users on Discord that all funds were accounted for and that they hadn't found any exploits or vulnerabilities. Looking ahead, HyperEVM is set to be Hyperliquid's biggest upgrade. It's an Ethereum virtual machine built right into Hyperliquid's Layer 1. This means Ethereum and EVM developers can deploy smart contracts and decentralized applications on Hyperliquid while still enjoying the speed and efficiency of HyperBFT consensus. Hyperliquid says that HyperEVM is different from other EVMs because it's deeply integrated with Hyperliquid's built-in order books for spot and perpetual trading. This lets ERC20 tokens connect directly to Hyperliquid's native order book, making it easier for projects to build DeFi applications that work like centralized exchanges but stay fully on-chain. And beyond just trading, HyperEVM could play a big role in expanding Hyperliquid's ecosystem, which now includes wallets, lending platforms, trading tools, oracles, liquid staking, and even AI-driven applications. Just recently, in mid-February, HyperEVM launched on mainnet. This could be crucial for Hyperliquid if it wants to keep up the explosive growth it's seen so far. More DeFi applications, integrations, and developer activity will be key to long-term adoption, and of course, centralization is still a big worry, one that could hold back progress in an industry that values decentralization. So, what do you think? Can Hyperliquid be the next big thing, or will its centralization issues hold it back?